Good morning, everybody, and welcome to Elite Wealth and the launch of our new ETF-based investing system called the Elite Fund Maximizer. My name's David McCulloch, and sitting alongside me today is our investment strategist, Jeff Saffer. Hi, Jeff.
Hi, Dave, and hello, everyone.
A great pleasure to be here with you today, welcoming not just our Elite Traders Club members and our Elite Investors Club members, but also general guests of Elite Wealth today. Great to have so many people attending the webinar, and we're sure that you'll get a lot out of the session. We're very excited about it, so let's get underway. The agenda for today, we're going to talk about the Elite Fund Maximizer and why the system was developed initially, how it evolved, how it came to be. We're then going to have a look at the mechanics behind it. How does it actually work? Very importantly, the back-tested results. Jeff and I have spent a lot of time on this particular product, and it's been very important. One of the key criteria for us is that it needs to be very robust. So we put a lot of work into that, and indeed it is extremely robust. We want to discuss as well, all investing carries risks, so we want to go through and discuss some of those risks with you, but also on the other side of the equation, the potential rewards as well. I think one of the key aspects of this, Jeff, you'd agree, is ease of implementation.
Definitely.
Yeah.
Major advantage from this strategy.
Absolutely. And I think given that there are so many self-directed investors out there today, a lot of those people perhaps struggling a little bit in terms of either their time commitments to their investing or whether they perhaps don't have the necessary skills. So obviously ease of implementation was a big box that we had to tick, and importantly discussing how you can be involved. I just wanted to give a little bit of background about your host today, myself and Jeff. There's a picture of you, Jeff. Do you want to explain to our audience a little bit about yourself?
Yeah, so I'm a fundamental analyst, so my main expertise, I guess, is valuing Australian companies. So I analyse the market looking for stocks that are undervalued. That's my background. So I've studied finance for basically a decade, been working in the industry for longer than that. My personal approach and what I offer to my members as well is a growth at a reasonable price approach. So not necessarily translating directly to the strategy we're talking about now, but just a bit about my background is that I look for stocks that are growing, but also trading at good value. That's just my personal approach to the market. I run the Elite Investors Club for Elite Wealth, and this is I have weekly webinars telling my members what's going on in the market and why, what stocks I'd be buying, what stocks I'd be selling, and there's an education element in there as well, trying to teach my members about the market. Your Money, Your Call was recently on TV as a market expert, and I regularly contribute to most of the major finance papers, been on radio as well, so I've got quite a bit of background and exposure in the media and presenting to clients as well, both live and on air.
Yeah, excellent. And from my point of view, Jeff, as a fundamental analyst, is really good at keeping things very, very simple. Just one quick question for you, Jeff. Who is it that drives the market, the fundamental guys or the technical guys?
Well, from my point of view, it's definitely the fundamentals.
Yep.
I mean, in the short term, on a maybe on an intraday basis, in the next 10-15 minutes, it's going to be the technical traders and a lot of algorithmic trading as well. So the computers are literally running off patterns, but that's not going to push the market up in the next month. That's going to move it in the next minutes, next hours. Over the long run, the market moves according to fundamentals.
Yeah, absolutely. All right, and a little bit about myself, a technical analyst, so I sit on the other side of the fence to what Jeff does, but certainly I couldn't do the work that I do from a technical point of view without Jeff and people like Jeff doing all their analysis on the market, and therefore a lot of these people like Jeff actually being responsible for large pools of money and having to find a home for that money is really important, and so a lot of research, a lot of analysis has to be done, and that's where people like Jeff really do move the market. So it's the ebb and flow of money into and out of stocks that the fundamental guys do, and from a technical point of view, we get to see that on a chart. We interpret the pictures that makes, the trends, the patterns, etc., over a period of time, and base our strategies on repeated behaviours, if you like. As a market educator, I get to spend a lot of my time helping clients improve their analytical skills from a technical point of view, their risk management, their money management, and obviously the mindset, so the application of their trading rules, which is, for some clients, is a bit of a challenge and something that people have to work at. I also run the Elite Traders Club, a product where clients get to tune in once a week and listen to my particular analysis from a technical point of view on the market. And recently I've been contributing to the terms of trade in the Herald Sun, some of which you may have read recently. That's enough about both of us for the time being. Let's get underway with things, Jeff. First of all, our disclaimer that we have to provide, and the content of this presentation or any other Elite Wealth material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances.
We'll let you revisit this disclaimer if you want to read it in full, or pause the video if you're watching it on replay. The one thing I will also mention from the disclaimer, I won't go through all of it, but we do say in there that past performance is not a reliable indicator of future results. So we will be mentioning some performance results today. So just remember that there's no guarantees that that's going to happen in the next number of years. We'll be able to 100% replicate those numbers.
Yeah, fantastic. All right, so let's proceed. So first cab off the rank, obviously investing challenges. Jeff, we've spoken with literally hundreds, if not thousands, of clients on individual levels, collective levels, etc. And one of the challenges, which has become really quite obvious, is the lack of education, particularly given that we've got such growth in self-directed investors, people who are looking to take control of their own funds, where they've wrestled it away perhaps from maybe a managed fund or a financial advisor. What are some of the things that you see as challenges for the investor?
Yeah, look, for me, the biggest issue, and I've said this before, is that I'm not a qualified heart surgeon. So if I needed a triple bypass, I wouldn't feel confident performing that operation on myself. I would go to someone who spent years studying and try and find the person that's had the most experience and has the best track record.
Yep.
Whereas so I wouldn't build my own house. I wouldn't give myself heart surgery, but the same surgeons or builders or teachers or engineers, whatever the profession is, a lot of these people think, I haven't studied finance, I haven't spent years and decades in the industry, but I've got $500,000 of my own money that I trust myself to look after.
Yep.
So I find that a bit interesting, and so I think some people are maybe looking after their own money without the expertise, and that's okay if you don't necessarily have the expertise. You can build that up, but you need a system, I think, is the biggest issue for most investors. They have an idea about the market, they've got a bit of experience and education, but if you're just changing your ideas from one day to another, chasing trades, getting in and out, not managing your money cleverly, if you don't have a plan and a system, you're going to struggle.
Yeah, I think you've hit the nail on the head. They're really just having a systematic approach to the way that you invest is really, really important. A lot of people don't have that. One other aspect of it is the amount of time to manage your portfolio. I saw a recent article that said, quoted that a lot of self-directed investors, particularly those looking after their own superannuation, were spending up to 3 to 4 hours a week managing their portfolios. Well, that's a good game of golf that everybody's missing out on a weekly basis, because they're having to spend all that time looking after their portfolio.
A key issue is getting that time regularly. So it depends on your investment strategy. Some you don't need to keep an eye on every day. Some you do. Yep. But certainly if you spend a few hours a week looking over your portfolio, and the next week and the next week, then you decide to go on holidays for 6 weeks and I'm not going to worry about my super now. You come back, you get a nasty surprise. So it's not just getting the time, but committing to it, doing it regularly, because financial markets don't really give you any breaks. And if you don't stay constantly on top of it, you're going to run into trouble.
Yeah, absolutely. Certainly there. Poor diversification is another criteria or another aspect of portfolio management. I think a lot of people in Australia are very much Australia-centric in the way that they invest, and as a result not getting exposure to those other markets around the world that are really moving and as a result really underperforming. Clients who perhaps do go down the path of having management fees, not management fees, but managed fund type of products, that certainly does allow greater diversification. The flip side of that, though, is...
Well, we've actually got one of the largest managed fund industries in the world.
Yep.
It's very impressive. And, managed funds help you address sometimes the diversification issue, but to me it's always had weaknesses. I actually started out in the financial planning industry back in the day, and managed funds were probably the number one product of choice, but they're clumsy from my perspective to invest in, to get in and out of. Like you said, volatility, liquidity's not always there.
Yep.
You're always dealing with the counterparty, so
Yep.
If you're buying and selling off a particular company, they're not going to do you any favours. And obviously the management fees. Some managed funds have fees of 2.5%
Yep.
a year.
Yep.
And in a lot of cases, you're paying for somebody to look after your money, and they're not even doing as well. In fact, they're doing worse
Yep.
than if you just put the money into the market directly.
Yeah.
So you're paying for the privilege of worse performance,
Yep.
which has always annoyed me. And to be honest, probably the main reason I got out of financial planning to then invest in the market directly, because sometimes it can be an unnecessary
Yep.
layer.
Yeah, yeah. There's certainly lots of evidence out in the US in terms of their managed funds over there that up to 75% of managed funds in the US have actually underperformed the benchmarks that they're trying to beat. So not only are you paying management fees on top of that, you're actually getting worse performance along the way.
So I think the idea of the managed fund is excellent.
Yep.
The execution is where it falls down.
Yep.
So what we need to do is find something that looks to achieve the same goal,
Yep.
easy, instant diversification without the drawbacks.
Without the drawbacks, absolutely. All right. The man on the screen there, Warren Buffett, I don't think he needs too much of an introduction there. Investing doesn't need to be difficult. I mean, everybody knows Warren Buffett. We know about his strategy, really. His favourite time frame for investing or buying a company or holding a company is pretty much
Forever.
So his approach is very much a simple one, and I actually wrote an article recently in the Herald Sun just about Warren Buffett and his particular strategies. A lot of people might know, or they may not know, that recently with his he wrote a will, and basically the instructions to his estate that's going to look after his fortune when he leaves us. He's instructed his estate to invest 90% of his funds into a low-cost index fund. So not a managed fund per se, but a index fund that follows a particular index. And in this case, in Warren's case, he's choosing an index fund based on the movement of the S&P 500. Why do you think he's doing that, Jeff?
Look, Warren's built up a reputation as basically the world's greatest stock picker.
Yep.
And he recognises that most people are not as talented as him, and if you can't beat them, it's a little bit of if you can't beat them, join them approach.
Yep.
And if you're not as smart and as canny as Warren is, the easiest or smartest thing to do, in his opinion, is put your money in the market in the most efficient way possible.
Yep.
And the way to do that is to just put it in an ETF.
Yep. An ETF is an
exchange traded fund. So instead of going out and telling his estate to go and buy 500 companies in the US to get that exposure, with one click of a button he can buy a fund that gives them exposure to all of that instantly.
So from Warren, obviously a key line of investment, if you like, is just to keep things simple, and that's what he's got planned for his estate. Let's jump on to our next slide here. The background. Okay, exchange traded funds there. Jeff, you were just talking about what an exchange traded fund is.
So we've touched on this. I mean, I like to explain exchange traded funds by starting off talking about a managed fund, and this is what most people understand. So a managed fund, if I wanted to buy we know the ASX 200, the index has 200 stocks. I could choose to just go out and buy some CBA or some NAB shares and BHP, etc. Or if I want some more diversification, I could go and buy 200 stocks. And that way I have, let's call it the Aussie market in my portfolio.
Yep.
The problem is buying 200 stocks is very expensive, lots of brokerage, lots of admin, takes lots of time. It's not a very efficient way of doing it.
Yep.
So what a managed fund aims to do is to get a whole bunch of individual investors that are trying to invest in the same thing, pool all their money together and invest in something. So you can have a managed fund that invests in the ASX 200, that invests in property, that invests in gold, all sorts of things, in Indian shares.
Yep.
And it's just an easy way of someone sitting in the middle, pulling all of the investors' money into a central pool, buying whatever investment is, and then giving everyone a small share of that pool. And that's what a managed fund is, and that's, I mentioned, is been a very big part of the investment landscape in Australia.
Yep.
We've talked about some of the drawbacks. If you want to buy units in this, typically you have to fill in forms, send off checks. It might take a couple of weeks for you to get your units. When you want to sell out, similar thing, you've got to fill in a redemption form, all sorts of things like that. And going back to the GFC, because you're filling in forms for someone to execute for you and then send you a check or a deposit in your bank, some funds ran into trouble and said, no, we can't hand back your money at the moment because our assets are at risk and we can't sell everything at the same time. So it's not very efficient.
Yeah.
I mean, in a modern age where you can do everything instantly on the internet, and you can buy managed funds directly through the providers, but it still is quite clunky.
Yep.
And we also mentioned because of a managed fund will typically, some of them are passive.
Yep.
They just say, look, there's the market, we'll just buy the market. Some say, we'll try and beat the market. Those funds tend to have analysts, a big team, a big customer service team, admin, lots of costs involved to run it.
Yep.
And obviously the customer always pays for it.
Sure.
An exchange traded fund takes that concept of a managed fund and says, look, we're not going to have all the paperwork. We are going to list the fund on the market.
Yep.
And so you can buy an exchange traded fund the same way you can buy BHP shares.
With a click of a button.
With a click of a button.
Yep.
Yeah, and you can decide what price you want to pay, how many units, listed on the ASX. So if you've got a ComSec platform or whatever it is, whatever you trade through, an ETF is just as easy to buy as an individual share.
Sure.
You can see the prices every moment the market is open, as opposed to a managed fund. They usually quote prices once a month or once a week, maybe once a day. So to me, managed fund is an old school, a slightly antiquated way of diversifying. An ETF is a more modern way, better liquidity, better access, and importantly, much lower admin fees because they don't have as much operations to pay for. So that's why I would invest in an ETF. It gives you instant access to whatever asset you're looking for, whether it's overseas shares, commodities, FX, a particular style of investing, property, etc. There's an ETF that basically covers anything. You can buy it easily, quickly, cheaply, and just sits in your portfolio like anything else.
So you've got you've got some of the benefits of like managed fund product, but you're actually self-administered. So a lot easier for self-directed clients. Why not a buy and hold approach, Jeff? If we're talking about ETFs, and Warren Buffett was talking about, well, put all my funds in an index-based ETF, as an example. And he's basically, as we know, his holding time is forever. Why not buy and hold?
Yeah, look, I've done a lot of work. I mean, I'm an Aussie share specialist, and I've done a lot of work. I've developed some systems that tell me when to be in and out of the market, particularly for Australia. And over the last sort of 10 years, just by using a very simple strategy that I've taught in 20, 30 minutes to some people, you can almost double your returns just by having signals of telling you when to get out of the market. My signals... you would have been able to avoid most of the GFC. It wouldn't have got out exactly at the top.
Yep.
Wouldn't have got out back in exactly at the bottom, but fairly close, and you would have avoided a lot of pain.
Yep.
And it also got out during the original European debt crisis. You could have sat in cash for a couple of years.
Yep.
So it offers better returns and lower volatility, because in the bad times your portfolio's not going down, you're sitting in cash. I know you've done similar work on the S&P 500.
Yep.
You've developed a few systems, a few signals to get you out of that, and over the long run, you can buy and sit in it for 20 years, and you'll have 5 good years, 2 bad ones, 5 good years, 2 bad ones. And if you're willing to sit through all of that, then that's fine. Personally, I would like to try and capture as much of the good 5 years as possible. I would like to avoid as much of the bad 2 years as possible.
Yeah.
And I think that is achievable.
Yeah, absolutely. I think a big key to our performance is just not being in the wrong markets at the wrong time, but also not all markets move in tandem together. And so it's been quite obvious in our research that there are actually other markets that move counter to the main market that we might be looking at. And I think that's a really important concept which we'll touch on in the next few slides.
Well, and just recently, I mean, you run weekly webinars and you look at the Aussie market, US market.
Yeah.
Broadly speaking, the US market is about flat this year, and the
Correct.
Aussie market, after a little pop higher, is up maybe 4 or 5% this
Yep.
year. In that same time, I mean, obviously we've had a bit of a crash in China recently,
Yep.
but the Japanese market, I think, is up about 40%.
Yep,
The German
definitely.
market is up maybe 30%.
Yep.
China was up 150%
Yep.
in 12 months. And so if you're just focusing on Australia, and you just sit in there all the time, you're missing the best opportunities when other markets are moving.
Exactly.
So what the aim of what we've been trying to achieve is to define it, what we call the universe, the best group of ETFs.
Yep.
That give us exposure to different kinds of markets.
Yep.
That at any given time, if the Aussie market's suffering, and the US market's suffering, and in China, etc., there's going to be something somewhere around the world that is performing well.
Absolutely.
And so if you've got the right group, you're always going to find an opportunity, a good investment opportunity, and you don't have to be invested in the market just for the sake of it.
Yep.
You're invested in something that is moving in the right direction.
That's right. And if you think about it, there's a lot of money around the world that has to find a home.
Yes.
And that's a really important concept in the background as well. So these ETFs, Jeff, that we're talking about, whereabouts are they traded?
So the ones that we have developed our system on are actually traded in the US.
Yep.
In the US, the ETF market is similar to what our managed fund market. It's a very big booming market. In Australia, it's quite fledgling. It's only been around. It hasn't been around for very long. We're starting to see a few more pop up recently. But if you want to gain exposure to all types of different asset classes and regions, you're going to find that there just aren't enough and the right ETFs in Australia.
Yep. Okay.
Last week I was on TV and someone rang up and said, I want to invest in India. What's the right ETF for me to buy?
Yep.
And I said, there isn't one in Australia, but there is over in the US.
Yep.
So we've picked a group of ETFs that are actually traded in the US.
Yep.
Because it's a much better and bigger market over there.
Yep. Okay. All right. Well, speaking of that, let's have a look at an example, a selection, a potential universe of ETFs. So we've got a number of stock codes or ETF codes up here: BWX and DBC, QQQ, and a VWAB, and etc. etc. So Jeff, given that there's a broad universe, an example of ETFs there, what's the typical, I guess, selection criteria that you would go through when you're putting together a list of ETFs as part of your investing universe?
Yeah, look, from our perspective, and what you and I have done, in the last year or two, has been quite comprehensive. It's probably more comprehensive than a lot of people would do.
Yep.
We've done a lot of testing involving a lot of correlation in particular, but a number of different factors. So what we're looking at is a group of ETFs that that gives us exposure to different types of markets in different areas.
Yep.
That, as you mentioned earlier, are also some counter trend. So if the Aussie market is suffering, what kind of markets would be going up? When the US is suffering, what kind of markets are going up? If share markets around the world are suffering, generally speaking, it's a good time to be in bonds. we're looking for ETFs that respond to rising global interest rates, falling commodities, other asset classes, etc. So what we're aiming to do is to spread different asset classes, different regions we're actually looking for ETFs that perform very differently.
Yep.
Because the theory is that at any given time, something is going to be performing well. And just off these ones, we've got a lot of share funds in Australia, Germany, Hong Kong, Japan, France, Europe, America, the NASDAQ, etc. But then we've also got ETFs that are exposed to volatility, to bonds, some commodity funds, gold, oil, copper, treasuries, all sorts of things. The US housing market. So you can see that there's quite a wide range.
Yep.
And at any given time, some of those some of them will be going gangbusters. Some of them are going to be performing very poorly.
Yep.
If you have the right universe, there's always going to be something that's an appealing investment opportunity.
Yep. Okay. So a broad basket of ETFs is what we're looking at, and again, making sure that we've got not too many that are highly correlated, that we also have a degree of anti-correlation, if you like, which obviously has implications for when broadly some markets are in a downward bear market as an example, and seeing other markets move in counter directions. And we'll go through and we'll explain some of those concepts as well. All right, so let's have a little bit of a look. Let's start getting into more about the mechanics of the ETF-based system, Jeff, the Elite Funds Maximizer. Methodology, it's a passive once-a-month review. So what does that mean?
So, an ETF you could buy today and you could sell on Monday, you could buy it and you could sell it in 10 years.
Yep.
It's up to you. So there's no specific holding period for ETFs. It's whatever's right for you. We've done a lot of testing and on our system, and looked at trading in and out of ETFs every month, every quarter, every 6 months, every year, and just about everything in between.
Even shorter time frames
twice a month, every week.
Yep.
The shorter time frame, generally speaking, the strategies that we have tested, the shorter time frames tended to be more profitable because you're reacting to the market quicker.
Yep.
But obviously the shorter time frames, if you get really short, then you tend to overtrade too much,
yep,
and the commissions start adding up. So it's finding a nice balance between being really active and being able to catch the latest trends,
yep,
but without overtrading. And we've found through quite a lot of testing that the system and the ETFs that we've developed, the universe we've settled on, works fantastically on a monthly basis.
Yep.
And to be honest, it's probably a fairly clean method for an investor. If you think about it, I'm going to put my money in there for the year, check it once a month, so you're in touch with the market periodically. You don't have to keep an eye on the market every day. You're also not leaving it for 6 months and going, oh, am I up or down? I know I get my super statements every 6 months, I actually log on in between to see how things are going, but most people don't know, and they just go, oh, I made 10% last 6 months, or I lost 7%, and they have no idea. So I think monthly is a nice period for that as well.
Yep. Now, the methodology says to invest in the top 2 ETFs. So out of the universe of ETFs that we're looking at, all we're doing is we're selecting the top 2. Now, if I'm thinking about that from an outsider's point of view, I'm thinking the top 2, isn't that, the diversification thing, if we're just getting into 2 ETFs, is that a concern?
No, in my opinion, not. I mean, certainly you don't want to, if you invested in 25 a month, you're going to have less volatility because you're further diversified.
Yep.
But then you're never going to beat the market if you're invested in everything.
Correct.
And if you're buying and selling 25 ETFs every month, your commissions are going to go up, etc.
Yep.
And you're going to have the good ones and all the bad ones as well.
Yep.
So you want to limit it,
yep,
not too much,
yep,
but find a nice balance between getting the best ones, but also retaining the diversification. Now, ordinarily, I wouldn't suggest most people invest in 2 stocks in their portfolio. If someone said, I've just got some BHP and Commonwealth Bank, and I'm just going to hold them, and then I might sell out and I'll buy NAB and Rio, I'd say that's pretty risky.
Yep.
One of those stocks could have something go wrong and your portfolio could fall by...
Stock-specific risk, as an example.
Exactly.
Yep.
The reason why I'd be much more comfortable holding 2 ETFs is that one of those ETFs might track the S&P 500.
Yep.
So with your one investment, you actually got... Essentially, you own a little bit of 500 stocks.
Yep.
And another one might be investing in US Treasuries.
Yep.
So... Look, there's still risk. If the US government goes bankrupt or 500 US stocks all go bankrupt, you're going to lose a lot of money. But obviously that's very unlikely and a lot significantly less likely than holding an individual stock that's going to have some bad news.
Yep, absolutely.
I'm not sure if you discuss it later, but one of the things that appeals to me about trading ETFs, for most people, the way I look at the market is I'm trying to find individual stocks that are going to outperform, and I might get into a stock a week before it reports its results, and they might have really good results and the stock goes up 10%, really bad results could fall 10%, but I back myself with my experience and knowledge to be on the right side of that ledger more often than not.
Yep.
For most people, it's a bit of a gamble, and the stock could come out with a random announcement and it's down 30%.
Yep.
An ETF doesn't do that.
Yep.
Because an ETF is tracking, generally speaking, a group of investments.
Representative of a broader basket.
So you invest in the S&P 500, Google comes out with a really bad result, Google shares drops 20%, but the ETF falls 0.5%. So you have much less risk from that perspective.
Yeah, so volatility, the aspect there is really important. Now, obviously, in terms of measurement of progress and results and things like that, we need to compare the results of the strategy against a benchmark. Now, in this case, the benchmark that we're using, because we're obviously based in Australia, we've chosen to use the All Ordinaries Accumulation Index. What's that, Jeff?
Okay, so we've all heard of the ASX 200.
Yep.
Oh, I assume most people have. Another common index or way of tracking the Aussie market is the All Ordinaries Index, and that actually tracks theoretically the 500 biggest companies. Right now, someone can't count. It's only got 492 in there, but that's beside the point. If you bought something that tracked the All Accumulation Index, you're basically buying a piece of 492 individual companies.
Yep.
We've actually chosen the All Ordinaries Accumulation Index, which includes dividends.
Okay.
So we're basically comparing our strategy to pumping your money into the Aussie market and just letting it sit there.
Yep.
Obviously, shares go up and down, getting dividends, reinvesting dividends. So it's basically comparing it to a buy and hold strategy in exposed to Australia. And I think
that's what a lot of people still do, isn't it?
Yes.
Buy and hold.
And I read recently that Australians are certainly from shares are about 98% exposed to Aussie shares, and they have a 2% exposure to overseas markets. Now, our members probably are a lot different to that. We've been talking about the US market for many years, but most investors are very narrow-minded in Australia. We do have a good stock market, but it's not always the best place to put your money.
They're very loyal, aren't they?
They are. Very patriotic, I guess.
Yeah.
But when it comes to my portfolio, I want to be profitable rather than patriotic.
Absolutely. Okay, so let's have a little bit further, peel back a few layers on the actual method. So we've got a universe of ETFs, which we've talked about. A degree of correlation and anti-correlation is very important across different sectors and different markets. So it comes the end of the month, we need to choose 2 out of that basket. Well, how do we go about choosing them? What are some of the metrics that we use to try and identify the 2 ETFs that we want to invest in for the next month?
Yeah, look, I without giving away all the mechanics and the formulas that go into it, the general approach is we're looking for momentum. Okay, we're looking for the markets that have the best chance of moving the fastest in the next, the best risk return payoff in the month ahead. And so we're looking at things like relative strength, volatility, performance metrics, and a number of other indicators as well. And the reason why you've got the picture of the horse race there is I liken the strategy, and this is probably the best way I can explain it, hopefully, is that if you were comparing it to betting on a horse race, most people bet before the race, they do all their analysis, they put their money on one horse, and they leave it, and at the end of the race, they either win or they don't. What this looks to do, and imagine if you could have that same horse race, and you could do, or you read your form guide, etc., and you put your money on the horse you think is going to win. And it gets 200 yards into the race, and you see that the horse third from the front is moving really quickly, and it looks like it's going to overtake. And imagine being given the opportunity by the bookie to pause the race, take your money off the other horse, and put it on that one. And then you press play, starts again. You do this every 200 yards, and think about it, 200 yards from the end. When I've ever watched a horse race, you can always tell almost which horse is going to win. Something comes herring out around the outside.
Yep.
And if you could pause and say, I'm going to take my money off the horse in front.
I want to get on that one.
I want to get on that one.
Yep.
And that's the strategy. So instead of just betting on the market,
Yep.
investing your money in the market at the beginning and leaving it, we're given the opportunity to periodically, every 200 yards or every month, say, this is the one that has the best chance.
Yep.
And so we're basically switching to, we're jockey that can press a button and jump on whichever horse we want.
Whichever horse is moving faster over that period of time.
Correct.
Yeah, absolutely. So one of the things behind momentum, Jeff, we talked before about there's a huge amount of money out there that needs to find a home. And guys like yourself, fundamental analysts, are doing their research, researching markets and saying, well, look, this is a market that potentially is going to perform well over the next 1 month, 6 months, 12 months, etc. And so behind this momentum, if you like, is what it's really tracking is money flow into particular ETFs. Now, obviously, as the example there, the jockey jumping off one horse onto another. So our job in providing the Elite Funds Maximiser through using our scanning methodology is to try and find that money flow, basically, isn't it?
Yes.
Okay. So at the end of each month, we run our scan, and then from that scan is selected 2 ETFs. So what do we do with our capital? Do we split it 50-50 or 80-20 or what would the approach be?
Yeah, so it is a 50-50 split.
Yep.
There's no... they come out as ranked number 1 and 2.
Yes.
But you do split it 50-50. There's no playing favourites.
Yep.
And you sit in those 2 ETFs for the month. Fast forward the next month and repeat the system again.
Okay.
Run the scan. Sometimes the ETFs in the second month are the same as the first month. They say, look, the best 2 are the ones you got into last month.
So no change.
So no change.
So we're still on the same horse.
You stay in them because
Yep.
you got a good one. It's got plenty. It maybe didn't have any cobalt or anything, but it's a well performing horse,
Yep.
And you can stay on that one. But most months it will say, the ones you were in last month might now be ranked 3rd or 4th, and
Yep.
you sell out of those 2,
Yep.
and you just shift into the next month's
Okay. So
selections.
what day of the month does that occur?
Yeah, so we're running our scans on the end of the month, so the last business day, which, as an example, of perfect timing would be today. So the very first business day of the next month, we say it's trading in the US.
Yep.
So we say this is what we would buy on the US tonight on the first day of the month.
Yep. Okay. And then mid-month, do we inform clients about what's happening?
Yeah, look, we'll maintain. I mean, the main information comes at that first day of the month.
Yep.
But so you're not left there hanging in between. We'll have a blog. We'll be releasing mid-month updates.
Yep.
Certainly, if there's anything you need to know about this month's selections or anything else going on around the world, so we'll have some information. But the main thing you need to pay attention to is that once a month.
That once a month, fantastic. All right, so the signals at the end of each month, clients will get a monthly email as soon as the scan's been run.
So we'll actually run a webinar each month.
Yep.
Saying, look, we've run our scans. This is what last month we made X%. The market returned X%. We outperformed, underperformed. Historically, we've outperformed quite a bit.
Yep.
And we'll say this is why we made or didn't make money last month. Now, that's last month done. What to do this month? Sell out of A and B, buy X and Y.
Yep.
And this is what's going on in those markets, and this is why we think it's a good place to be. Action this month, sell this, buy this.
Yep.
We'll send out the webinar. If you don't even have time to watch that, the email will just have the crux of it, the conclusion, buy this, sell this. And that's all you really need to know.
Simple directions. That's once a month.
Once a month, first day of the month, you set your clock to it, set an alarm to watch us, or if you don't want to, don't watch us and just wait for the email that comes out that has all the instructions in it.
Couldn't be much easier than that, could it? obviously, as part of the elite traders from a technical point of view, I'm always talking to clients about on-stop orders and limit orders and those sorts of things. The orders that we place when we get the signals.
Yeah, so they are intended to be at market, so we want to get into the market straight away at whatever price it opens on. There are some because we're in Australia and we are trading US markets, you can't buy the stock at 2 o'clock in the afternoon because it's not trading. So some sophisticated platforms will actually allow you to place an at-market order. An example would be Interactive Brokers. It's the largest online broking platform in the US. Even Australian clients can say, when the market opens, put a market order in for me. Some other platforms will say, I can't buy your shares at market because the market's not open. You might need to use on-stop or limits. It may be slightly less effective or a little bit more convoluted, but either way, it's pretty easy to buy that night. So if you wanted to do it perfectly, I'd suggest finding a platform that will allow you to place an at-market order.
Okay. All right, so we've got these signals coming out once a month based on a series of metrics around momentum, etc. In consideration of putting the strategy together, Jeff, before we launch it, we've got to go through a lot of back testing, a lot of rigorous back testing. So just some of the, I guess from that point of view, some of the considerations, just to give the audience a bit of an idea as to what we had to go through to get to this particular point.
Well, a lot of blood, sweat and tears, I guess. But
a lot of tears.
Yes, a lot of tears. Look, in terms of the testing, obviously testing different combinations of ETFs, different time frames, different settings. We've got a number of different metrics that go into the scan, so working with the scan. Now, it would have been easy to do all this testing and just find the result that gave the highest return. That would have been the easiest way to do it, but that wasn't our main or only focus at all. What we were looking for is a system that provided consistently high returns. At the same time, it had lower volatility than the market. At the same time as that, it also had lower drawdowns. So when the market does turn, the point from the top of your account to the bottom of your account and the dips was as small as possible. And we were also looking for a system that would work in all market conditions, not just a bull market for stocks. Probably more effort went into finding ETFs and optimizing the system so it worked in bear markets. Because anybody, to be honest, just about anybody can make money in a bull market. It's not that hard. The bear market is what separates the good investors, traders from the bad ones, and it's what separates the amount of money you have in your account at the end of the day. Whether you were able to protect. In this case, our strategy actually grew the portfolio balance significantly. Some of the best years for this strategy was in 2008. I think might have been possibly the very best year or close to. And so we were looking for a system that worked in all market conditions, had a good strike rate, high returns, low volatility, low drawdown. That is really the holy grail. And we believe we've managed to achieve that.
Absolutely. Sharp ratio, Jeff. What's the Sharp ratio?
So what the Sharp ratio does, I mean, it's a fairly, I wouldn't say complex, but it's a fairly sophisticated financial tool. And what it looks to do is assess how efficient a strategy or a portfolio is, and it basically compares the returns to the amount of risk. Is the simple way to explain it. So if you have a system that has really high returns but outrageous risks, and one that has solid returns and not a lot of risk, a lot of people would jump to the really high return strategy and go, that's fantastic. But in theory, that's not actually a very good, you're not getting good bang for your buck. That's the best way I can explain it, a financial bang for your buck. The most amount of return for the least amount of risk. So you want a high number in this. And it is probably the number one thing that a professional investor would, if they were looking to invest in a fund, the Sharp ratio would be the number one thing they look at.
Absolutely. All right, well, let's see what the thing's done. Okay, so there's a chart here, Jeff, the performance since 2003. We started back in 2003. What's the main reason for starting in 2003?
Look, this is the beginning of the bull market in Australia that went obviously till late, from March 2003 to late 2007. We then had about a 15-month bear market.
Yep.
Another stocks rebound of 6 months, struggled for a couple of years. So we've had the good times, bad times, good times again.
Yep.
So it was a really good microcosm of all different market conditions.
Yeah, because not just bull market and bear market, but sideways markets as well, which
Correct.
is really important.
So what the chart is showing, if you invested $100,000 into the Elite Funds Maximizer in the beginning of 2003 up until the end of June 30 this year,
yep.
the end of the financial year, the blue line is the EFM, the Elite Funds Maximizer, versus the orange line. It says all accumulation. It's actually the All Ordinaries Accumulation Index.
Yep.
So just putting 100 grand in the market, leaving it,
yep.
reinvesting, etc. And you can see two very different lines.
Yep.
I mean, to be honest, the blue line is so out of scale in terms of the gains compared to the orange that you can hardly even see the GFC in the middle.
Yep.
If you took the blue line out of that, the orange line would look much more volatile.
Yeah, absolutely. So you can see there, even the Australian market during the early 2000s was performing really, really strongly. Probably the strongest performing market in the world at that time.
Yes.
And the EFM, the Elite Funds Maximizer, was pretty much tracking a high-performing market at that time.
It was either in line or slightly ahead. So, admittedly, for 2003 to 2007,
yep.
it only did slightly better than the Aussie market. But the Aussie market was, as you mentioned, virtually the best market in the world on the back of that commodities boom out of China.
Yep.
After that point, things get very different.
Yep, and the ETFs that are in the universe there, Jeff, some of them will be providing dividends as well, which are being reinvested into the portfolio
yes.
at the same time. That's an outstanding performance from something that you just have to look at once a month. Split your capital between two ETFs, and then just wait for the next month, next signals, rinse and repeat effectively.
Correct. Yes.
Yeah? Okay. All right. Well, that's since 2003. So that's the chart. There's some of these numbers here in the table, Jeff. Obviously, a starting balance with the EFM and the benchmark, the end balance,
mm-hmm.
the total return, average return of 23.9% on the Elite Funds Maximizer versus 9.5% on the benchmark. 9.5% on the benchmark is not too bad, but that's during the ups and during the downs, isn't it?
Yes.
So we talked about earlier before that one way to outperform is just to not be in the wrong markets at the wrong times.
Yeah. Look, I mean, I don't want to read through every single number on the
yep.
on the table, and to be honest, the numbers are quite staggering, and
yep.
they're extremely impressive. But the main thing is obviously the total return has been much higher, the yearly return much higher. What's more interesting to me is the maximum drawdown.
Yep.
So the benchmark fell 55% from top to bottom.
Yep.
2007, 2009. The worst drawdown, the worst bad patch this system has had is 15.1%, which is phenomenal given we've been through the GFC and a lot of people lost half their wealth.
Yep.
Winning periods, it gives a positive return more often than the market. The best month has been much better than the market's best month. The worst month has been better than the market's worst month.
Yep.
The Sharpe ratio is what gets me. If I could sum up all of that in one number, the Sharpe ratio, how much bang for your buck, how much extra return are you getting for the amount of risk you're taking on, and the Sharpe ratio is close to 5 times.
Yeah.
So it's not only giving a return that is significantly higher, it's also delivering it with lower volatility.
Yeah.
And actually very interesting and important number on there at the bottom, ASX correlation, means how does this system move in comparison to the Aussie market. If we gave you a system that moved in line with the Aussie market, and you've got $100,000 in the Aussie market, and we give you another system to put $100,000 in, when your Aussie shares go up, this system will go up. When your Aussie shares go down, this will go down. And that doesn't really help you diversify and protect yourself.
Yep.
The correlation of under 30% is very low. It means these two have very little to do with each other.
Yep.
And which is what we're looking for.
Yep.
We want a strategy that is going to be able to deliver consistent returns no matter or despite what the Aussie market's doing.
Yep, certainly. Okay, well that's the long-term performance of the strategy. Let's just, again, from a curious point of view, how has the system gone in the last 5 years? So same starting amount of capital with $100,000, And as you can see on the chart there, the blue line, the results of the Elite Funds Maximiser against the All Ords Accumulation Index. Bit of a difference there, Jeff.
Yeah, look, I just looking quickly at the chart. I mean, the investing in the market over the last 5 years would have turned 100,000 into about 150 or a bit more.
Yep.
The Elite Funds Maximiser would have been, I think, close to 230,000. So there's a strong, even though this system probably proved itself the most during the GFC, that's when it really just kicked along.
Yep.
Still, the last 5 years.
The market's been volatile during that time. We've had the Eurozone crisis in the middle of 2011, and you'll see a little bit of a dip in the orange curve there. During that same time frame, the EFM, Elite Funds Maximiser, again, just steadily moving along.
And you can see when the Euro debt crisis really sort of had its biggest impact in sort of mid to late 2011, at that same time is one of the times when the EFM kicks off. So we're really looking to make hay despite what the market's doing.
Yeah, absolutely. And just a quick recap on those figures there again, Jeff. This is the table of the last 5 years' results. Average return over the last 5 years around 18%, versus the benchmark steady at around about 9.5. In terms of ASX correlation, 27%, so lower than 30 again.
Yep.
So again, really important. And again, the winning periods there, the strike rate, if you like, 65%. So again, very consistent in terms of that strike rate, and that's important because we know that from a psychological point of view, people like to win more often than what they lose. There are some strategies where you can actually lose a lot of the time but still make money, but they are very, very difficult to trade.
And most people can't handle that system.
Yeah, exactly. All right. Well, so
just while we're finishing off the performance figures,
Sure.
I should mention obviously that it doesn't take into account transaction costs and tax and things like that. So that will impact the numbers. But just keep that in mind when you're looking over those numbers.
Absolutely. All right. So let's go through and just talk about some of the risks. We've talked about some of the potential rewards, some of the risks. I mean, we want to provide a balanced view, Jeff. The risk side of things. This particular strategy, it's not a short-term strategy.
No.
Okay, so it's the sort of thing that, in terms of time frames, if you're looking to use the strategy, what would you suggest?
Oh, look, I'd say minimum would be 12 months.
Yep.
But I think it will prove itself to be most beneficial over a number of years because it actually gives the best value in different market conditions, not just consistently going up. So you want if you see some sideways, this should outperform. Certainly, if you see the market going down, this should outperform significantly. And to be honest, in an up market, it might just keep pace.
Yeah.
But if your worst outcome is just doing as well as the market, and in other conditions you're outperforming significantly, then that's what we'd be aiming for. So even though we're investing in an individual ETF for a month, the system is built to be used over a length of time.
Yep, fantastic. Another risk is not following each signal. So you get a signal at the end of the month and you think, oh, look, I won't put that one in because I was in that one last month, or that one last month didn't return as much as I thought it would, so I'm not going to put it in. And you don't put it in, and what happens?
In theory, it should go up and down in equal parts. I've seen this over the years in different investment products. People miss something, and in theory, it should swings and roundabouts. You come out square, but over the long run, especially considering that over the long run, markets tend to go up more than they go down. If you miss out, it's probably going to cost you.
Yeah, absolutely. And I think that's the main thing is with a strategy as simple as this. Once a month, there really shouldn't be any excuse for not following a signal per se. The other aspect of it, it's not a short-term strategy. No. So it's not sort of something that you put your funds into and take the first 6 signals and go, well, it's only returning what the market's done, or maybe even a little bit less than what the market's done. You need to have that, that longer-term view, because as we've said, there is periods of volatility. When it's completely in sync with the market, and then it'll be out of sync with the benchmark and doing other things because it's tracking that money flow, that momentum of other ETFs that are outperforming. So again, it's the sort of strategy that you need to be thinking about, longer term, minimum of 12 months preferably. In terms of risk, currency risk, because we're trading ETFs which are on the US, it means that we have to have a US based account. So there may be some currency risk.
Yeah, and that's fairly easily hedged.
Yep.
So if you've got $100,000 worth of ETF, you could short $100,000 worth of Aussie dollar.
Yep.
And it's that simple.
Yep.
Um,
Okay. All right. Well, we've talked a bit about the risk.
Sorry. You should be buying Aussie dollars.
Buying Aussie dollars.
Buying Aussie dollars.
As opposed to shorting Aussie dollars. Okay. So just a quick recap of what we talked about there today, Jeff. It's a once a month strategy, so simplicity paramount. Okay, so we're not spending 3 or 4 hours every weekend looking to manage the portfolio. It's once a month. We run the scans. We send out an update. We keep you informed bi-monthly as well. In terms of the back-tested returns, Jeff, what could you say about that?
This is some of the best results I've seen, and over my years of seeing a lot of systems, and we haven't tweaked it for our benefit. If I could have showed the last 3 years with a particular system, it would have worked. We've taken different market conditions in it, and it's held its returns through all of that.
Yeah.
And despite those high returns, that usually comes hand in hand with high volatility.
Yep.
This has had significantly lower volatility than the Aussie market.
Yeah, and that's important as well.
Yes.
Yeah.
And lower volatility still compared to investing in individual shares. The market as a whole in Australia is less volatile than investing in 10 individual shares.
Yeah.
And so you don't have that company-specific risk as well. Yeah. What we call unsystematic risk is gone.
Yep. Smaller drawdowns, really important. So in terms of the way you feel about things when you're going through your investing, smaller drawdowns is certainly a massive benefit for everybody. Significant Sharpe ratio. I think, Jeff, you hit the nail on the head there before in terms about the risk-free, what would you call it? What was the words that you used?
Well, bang for your buck.
It's
the extra return you're getting for the risk that you're taking on.
That's right.
Is sensational. And one of the highest ratios I've seen, pretty much the only thing I've ever seen higher than this, very complicated hedge fund strategies with years of algorithmic trading behind it that basically no one can implement. But in terms of a fairly normal strategy, it's extremely high.
Fantastic. And for those of you who don't have at least probably 30 minutes a month to invest your funds into the relevant ETFs, we also have an affiliated broker at 708 Capital who is more than happy to facilitate it on your behalf as well. So you can have the system totally automated, where hands-free. Yep. So that's another alternative for you as well if you don't have time to do it yourself. So getting started, the cost, and I know everybody's been waiting for this, is $1,200 per year with a monthly option for payment as well. Now, those of you who are part of either Jeff's Elite Investors Club or the Elite Traders Club will get this strategy complimentary for the current duration of your subscription. So that's a great thing. You're getting it absolutely free. Those of you who aren't members of the club and would like to register or participate in the Elite Funds Maximiser, very, very simple to do. Registration, you can do it in one of two ways. You can either jump on the phone at 1300 200 931, or you can email our member services consultant, Jeff Cornwell, and his email address is jeffc@elitewealth.com.au. You can drop him a line, you can ask him some questions, or easier than that, just jump on the phone and have a chat as well. Jeff, have you got anything further to say?
Look, I think the recap slide was pretty much the best I can summarise it all. A very easy strategy to follow that has shown in back testing really good results, low volatility. To me, it's hit the main things that I would look for in a system. Yeah,
absolutely. So what we might do now, given that we're getting close to our end of our webinar time, is just throw over to some Q&A. I know we've got some questions already there. We've got a question there from Danny. Hi Jeff and David, sounds fantastic. Is this aimed at self-managed super funds? Otherwise, how is the return paid out? Is it income or capital gains? Good question.
Yeah, so I'd suggest obviously always to consult your tax agent, but basically, well, it's going to be a little bit of a combination of both.
Yep.
So some of the funds will pay distributions, some don't.
Yep.
But the majority of the money that is made from buying at the beginning of the month and selling out at a higher price, making a capital gain.
Yep. And if there's any dividends during those particular holding periods, those dividends will be paid into your account as you go
directly.
as you proceed.
And it's actually probably perfect for an SMSF, which would have typically a much lower capital gain tax rate than an individual investor.
Yeah, because I think it's around about 15%. Yeah, hey, good question. Yeah, excellent question there, Danny. Any other questions out there? One from William.
Someone's just asked, we didn't talk about shorting ETFs, so that's correct. It's just a long only.
Yep.
There's no shorting. What we actually have done is some of the ETFs in the system, in the universe, are what's known as inverse ETFs.
Yep.
So when the market falls, these ETFs go up. So we're just buying. So you don't even you never have to short anything.
Yep.
It's just buying and selling. It's about as easy as it gets.
Yep. Another question there from Robert. What's the cost and detail of the broker automation?
Look, it's probably best to speak to the broker in question. Yep. I believe it's in the vicinity of $15 US a trade.
Yep.
And that starts out, obviously, if you're trading very big, large amounts, it goes up on according to a percentage.
Yep.
But I believe it's a minimum of 15%.
Yeah, $15.
Sorry, $15 per trade.
Yeah, that's right. Another question there. Recommendations for brokers for US markets. Okay, Neil, that's a great question. Look, there's a number of alternatives. Whether you like to trade the ETFs as an ETF or even as a CFD.
That's probably the first thing you would need to sort out.
Yep.
So that's the first question to answer. Look, the best the best platform with the best rates and capabilities for different types of orders I've seen is Interactive Brokers.
Yep.
That has access to excuse me, everything you would need, very cheap, and like I said, some really good types of orders as well.
Yep. And that Interactive Brokers you could set up through 708 Capital?
Yeah, and look, I would probably suggest that. I mean, I set up an Interactive Brokers account a while back, and some of the paperwork is actually a little bit of a pain. It's one of the more annoying, complex, I'm not sure, processes that I've seen.
But once you've done it, it's out of the way.
So then I've actually helped, since that I've actually helped a client set up an Interactive Brokers account through Nick. I know Nick set up, which is one of the contacts at 708 Capital.
Yep.
And he set up hundreds of them over the years, and so it just makes things so much easier.
Yep.
It's easier.
And certainly Saxo is another account that you can access all the ETFs through, either straight through ETF or through CFDs as well. Fees on the selected ETFs.
Yeah, look, that's a very good question. They range, obviously. Some are higher and lower. We have looked for the lowest cost ETFs wherever possible, if the return risk characteristics were almost identical. Typically, you're looking at somewhere between 0.25% to 0.75% a year. So let's call it somewhere around 0.5% a year. And once you're on the platform, you can click on any ETF on the system, and it brings up information about the ETF, what it is, what it exposes you to, the market cap of the ETF, average turnover, and expense ratio. So all the information is in the product, but the short answer is, roughly speaking, about 0.5% a year.
Yep, fantastic. Another question from Darren. Are the ETFs being scanned on the ASX or the US markets?
The US market.
Yep, the US markets. All right, any other questions? Some really good questions in there. Minimum initial investment. Good question.
Yeah, look, it's hard to put a specific number on it. It would come down to, from my perspective, when I talk about minimum investments, I always think about the way I approach it is fees and commissions. So if you were paying $15 a month in and out, you might be paying $60, $70 a month. And obviously, if you've got $500,000 in the account, $70 a month is not much. If you've got $5,000 in your account, $70 is more.
Yep.
So you'd have to just think about that, and I can't really give you an answer. I would say, generally speaking, it starts to make a lot more sense probably above 25,000.
Yep.
But the more money you put in can actually become more efficient if you are paying the same rates to get exposure to more units, and you're paying a smaller proportion.
Sure.
Hope that made sense.
Yep, good question, Peter. One there from Darren.
Could you use this strategy on options using credit spreads?
Well, I guess, look, it's something that you could. It hasn't been designed for that. It's really more a longer-term set-and-forget sort of strategy.
But I definitely think you could. I mean, the issue would come down to more of your personal circumstances. If you're trading at the money, out of the money, in the money, etc. We could prepare some statistics about what the average or median move is per month, etc. But look, so the answer is yes. Certainly, if you're looking for a system to identify stocks or ETFs, some kind of security that has a good chance of going up, then there's no reason why not. But it'd come down to being successful or not would come down to how you structure it.
Yeah, it hasn't been designed with that in mind. However, certainly once you're seeing the results of the scans each month, you could apply some of your own strategies to that if you wanted to.
Yeah, and it'd be worth joining if that was your intention. Certainly, if you've seen the system 6, 12, 18 months, however long you want to give it, you can test it during that time, your own option strategies, and see if they pay off.
Yep. A question there from Danny. Are these leveraged products?
No.
No. Okay.
So in some cases, we could have chosen leverage ones. So there's an ETF that follows the S&P. There's what's called as a 2 times ETF. So if the S&P goes up 1%, the ETF goes up 2%. We've decided to keep the leverage, therefore the volatility, as low as possible. We're probably looking to keep volatility low more than we were looking to increase returns.
No, great questions, everybody. Look, I'm conscious of the time. We've gone for just a bit over an hour and 10 minutes at this point in time, Jeff. I think probably the best thing, if anyone's got any further questions, is to just get in contact with us. Now, on the... Oops. Sorry about that, folks. I'll go back to that particular slide. There we go. We might just go back up one just for the contact details there. If you need to speak to any of us, please feel free to ring 1300 200 931. I'll be happy to take your call, or Jeff will. The other Jeff Cornwell, jeffc@elitewealth.com.au. You can send him a line. Certainly we'll be in touch with you, helping explain everything along the way and to get you started if you'd like to come and join us. So again, costs only $1,200 a year with a monthly option to pay as well. Those of you who are in any of our clubs, the Elite Traders Club or Elite Investors Club, as I said, it's complimentary with your membership. Jeff.
Okay, I would just that slide isn't coming up with the details, but it's the one we saw earlier. After this video is published, we'll put all the details in the email saying if you've got any questions, please contact us here. I know we've run out of questions, but someone has just said, when can we start trading? And so the first trades will go out on Monday afternoon.
So end of the month this week?
Yes.
So Monday morning?
Probably the video and email will probably go out in the afternoon on Monday. And afternoon's fine because the signals are to trade that night in the US. Some of you might need to set up accounts to access these, so you might not be able to kick off on Monday, but certainly for anyone that's interested, wants to start getting the content and the product, Monday is D-Day.
Absolutely. Right, thanks guys, and we look forward to helping you out along the way.
Thank you very much.